In this tutorial, I'm going to give you a brief introduction to perfectly competitive markets, and I'm going to explain to you how to read the side-by-side graph of a market and a firm, and we're also going to talk about specifically what does a firm in the side-by-side model look like when a firm is in long-run equilibrium, or what we would call economic profit, zero economic profit, or normal profit. So let's begin by pointing out that this is a side-by-side, meaning that we're looking at two different graphs. Well, what are we looking at? On the left-hand side, we're looking at the markets, and that might be what we think of as all firms. Okay, that means if there's 1,000 firms in this market, or 10,000, or whatever the number is, that's all of them, right? Let's take a market such as let's take the corn market, right? So the farming market. So there may be thousands of farmers. And so this represents all of the supply of farmers. So that's all the farmers and all of the demand for farm products, or in this case, corn products. And the price, the market price, reflects the supply and demand. So if the supply or the demand were to shift around, that price would change. But as it is right now, at this particular moment, the price is at $1. So the market price carries over to a particular firm, which is what we're looking at here. So this is a single firm. Let's say it's Farmer Roy. Farmer Roy is one of many farmers. And because he's a relatively small part of the market, and he sells what we would think of as undifferentiated products, meaning for most people, corn is corn, and they're not going to pay extra for Roy's corn because, they can get it from any farmer. So the demand curve for Farmer Roy's corn is perfectly elastic. That is, that it looks flat, right? Because a buyer will only pay up to the market price for Farmer Roy's corn, which is $1. Now, if Roy were to charge more than $1 for his corn, nobody would buy it. They would go to some other farmer, which is why we call this type of firm a price taker, meaning that this firm has to accept the market price. They cannot change the market price because, number one, they're a small part of the market, and number two, the products that they're selling are undifferentiated. Okay, so now that we've covered that, I also want to point out that the price in the market is also going to be the same as the price for the firm and the demand for the firm's product, the marginal revenue, which is the change in the total revenue due to the sale of an additional unit of output. So every time that Roy sells one additional unit of corn, he's going to get $1. And the average revenue is also $1. So all four of these things, the price, the demand curve for the firm, and the marginal revenue curve, and the average revenue curve, they're all going to be exactly the same number, $1. Okay, so let's start talking about what is it going to look like if Farmer Roy is in long-run equilibrium or earning zero economic profit. So Farmer Roy's average total cost curve is just going to touch that price. So the minimum point is going to be where it hits that $1 price. This is the way that it would look. And your marginal cost curve would intersect the average total cost curve at its minimum point. So this is your marginal cost curve. The rule for maximizing profit is always the same for all firms. And that rule for maximizing profit is that you produce at the quantity where your marginal cost is equal to your marginal revenue. And this is a rule that you're going to hear a lot in all four types of markets. So you want to produce where the marginal cost is equal to the marginal revenue. In this particular case, we see that the marginal cost intersects the marginal revenue right here. So they are equal right here. So this is the quantity that we want to produce at, okay? Because the marginal cost is equal to the marginal revenue right here. And we don't know what that quantity is exactly. We could just pretend that it's 100, okay? So the quantity here is going to be 100. So Farmer Roy is producing 100 units. And that would be his profit maximizing output. Okay, so this is the quantity that he's going to want to produce to maximize profit. Now, one thing that's often confused here is that just because Roy is not making an economic profit, it doesn't mean that he's not making an accounting profit. So an economic profit means that you're earning above and beyond the normal rate of return on land, labor, and capital. But he could still be making an accounting profit, meaning he's getting the normal rents on land, he's getting the normal rates of interest on his capital, and the normal rate of wages on his labor, okay? So this is often confusing for people because they say, oh, why would you want to produce if you're not earning any profit? They could be earning an accounting profit, just not an economic profit, meaning they're not earning any more than they could if they were deploying their land, labor, and capital elsewhere. Okay, so we will now want to talk about profit and loss, and we're going to have to talk about two concepts. First is the total revenue, and then the second is the total cost. So I'm going to start off by talking about total revenue here. The total revenue is going to be the price times your quantity. Okay, so the price that we're getting for this particular output is $1. And the quantity that we're selling is 100. Okay, so the total revenue for this firm is $1 times 100 equals $100. We also want to talk about the total cost. Because the formula to determine the profit is to take the total revenue and subtract the total cost. Okay, so the total cost is going to be, in this case, we're going to look at the average cost. And the average cost, we can find it here on the average total cost curve. Okay, so the average total cost at the quantity that we're producing, not here, but at the quantity of 100. The average cost also is the average total cost, so you could write it in either way, ATC times the quantity that we're producing. And the quantity that we're producing, again, is 100. Okay, so the average cost is $1, and the quantity is 100 equals 100. Okay, now if we wanted to recognize or to graphically illustrate, I should say, both of these things, I could actually shade in the area of total revenue. And that area of total revenue is up to $1 over to the quantity of 100. So the total revenue is represented here. Okay, that's your total revenue. The total cost could be shaded in red. And I'll shade it in a different direction. But the total cost is actually going to be the same area. And notice that they're exactly the same area. Okay, so it should follow that when we're talking about the profit or loss, the profit or loss, the formula here is the total revenue minus the total cost, right? So profit or loss is the total revenue minus the total cost. So when our total revenue is 100 and we subtract the total cost of 100, we end up with 0, right? So total revenue is 100 minus the total cost, which is also 100. We see that the profit is 0. Okay, so total revenue minus the total cost of 100 is 0. So we're not earning a profit here. Okay, and we'll spend more time talking about this before, but the total revenue minus the total cost is going to give you your profit. So once again, we're at 0 economic profit. All right, this concludes this tutorial. On this tutorial, I'm going to build on the last one, and we're going to talk about how a firm would look, a perfectly competitive firm, would look if it was earning a short-run economic profit. So everything is going to be the same. We've got your market on the left-hand side, and the right-hand side is going to be the market for a single firm. And again, we're going to use this Farmer Roy example. Let's suppose that Farmer Roy, we have the price still at $1. But in this case, if the average total cost for Farmer Roy was in a slightly different spot, and Farmer Roy was producing in a slightly different place because of his lower costs, let's say his marginal costs are here, and we'll stick with our old number of 100. But let's just suppose that in this particular case, his marginal cost and his marginal revenue are going to be here, right? Because the marginal cost and the marginal revenue are equal. Marginal revenue, marginal cost at this quantity of output. Let's suppose that the quantity of output is still 100 units for whatever reason. And the cost at this particular quantity of output, the average total cost is only at, let's just say, 90 cents. Okay, and it's at 90 cents. And if that were the case, that means that the total revenue minus the total cost equals your profit, or loss in some cases. His total revenue is going to be $1 times 100. Okay, so this is going to be his total revenue. We're going to use green again. Total revenue is going to be here. It's a little bit of a crooked box, but that's all right. Okay, so that's going to be your total revenue. You've got $1 times 100. Okay, so $1 times 100 equals $100. Now the total cost is going to be, because remember the cost is 90 at this unit, this quantity of output. The total cost will once again use a red box, and we'll do the lines on another angle. The total cost is going to be this box here. And it's not going to be the same as the total revenue, because we're at 90 cents times 100 units equals $90. Okay, so a total revenue of $100 minus the total cost of $90 is going to give us a positive profit of $10. Okay, so it's a $10 profit. Okay, so the area of profit, we could actually highlight this, right? So we could note that the area of profit is going to be this top area here. Okay, so your profit is the difference between the larger revenue side and the smaller cost side. Okay, a couple of quick points here. Remember that the cost is coming from here, right here, at the quantity that we're producing, which is, of course, where the marginal revenue equals the marginal cost. So we have the marginal revenue here and the marginal cost also right here at this quantity of output. Okay, so this is what it's going to look like when a firm is earning a positive economic profit. Now, in the long run, what we might expect to happen is if this firm is earning an economic profit, we might expect an increase in the supply to come in and push the price down. And that would then squeeze, it would also push the demand curve down to 90, and it would squeeze the profits so that this particular firm would not any longer be earning an economic profit. Okay, so, for instance, what we might see is an increase in the supply in the long run, so S2, and that would push the price down, and then the new price might be this 90 cents. Okay, so the price could come down, and the new price would be, say, 90 cents. That would also have a result in increasing the quantity. So you'd have a larger quantity of output in the marketplace. And this could also have some negative effects on the quantity that's produced here. I'm not going to go into that for the moment, but the idea is that in the long run, if firms see that Farmer Roy is making money here, they're going to want to hop into that market. And when they do, that's going to increase the supply and push those prices down and squeeze the profits out of this market in the long run. And this concludes this tutorial. In this video tutorial, I'm going to be talking about what happens and what are the conditions where a perfectly competitive firm continues to operate at a loss. So once again, we have our market or all firms on the left-hand side and the single firm graph on the right-hand side. And we're going to be looking specifically at what happens if, say, a firm is producing economic losses, and what are the conditions in which they would want to stay open. So let's begin by pointing out that the rule for operating at a loss is that you will only stay open if your price is greater than your average variable cost. So it's very important. If the price was less than the average variable cost, you would shut down because that would actually increase your losses. And loss minimization is a form of profit maximization. So we're always trying to minimize our losses. And so you would always want to make sure that your price is greater than your average variable cost. And that can actually help you minimize your losses by staying open. Let's begin by demonstrating or illustrating what it's going to look like when a firm is operating at a loss. So the average total cost curve is above the price or the marginal or the average revenue that you'd be getting. So you can already see that the firm is going to be operating at a loss. The average variable cost is going to be included in this graph because you need to know where that is in order to determine whether or not you want to operate at a loss. So I'm going to go ahead and fill in our marginal cost curve. And the marginal cost curve should intersect with both the average variable cost and the average total cost at their minimum point. Looks like I missed it there, but it's pretty close. So just forgive that. So in this particular case, we've got the same rule applies as always, which is that the profit maximizing rule is that you produce where your marginal cost is equal to your marginal revenue. Okay, so that's your profit maximizing rule, even when you're producing losses. And so where do we see that the firm should maximize its profits? Well, it's right here. Okay, so this is where your marginal revenue is equal to your marginal cost. okay, right at this point. So that is the quantity that you should produce. And let's once again say that that quantity is 100. It's the quantity that they're producing. We're going to be able to see right away that our total revenue is going to be $1 times 100 units. So total revenue is the price times the quantity. So price times quantity. Okay, and the price is $1. The quantity is 100. So the total revenue is going to be $100. And we filled this in over here with green. However, the total cost is going to be much higher. We need to go back up to where are we hitting at the quantity of 100 our average total cost curve, and it's right here. Let's just say that that is at the amount of, whoops, that's a little high there. Let's say that it was at the amount of $1.10. So that means that this entire area is cost above the revenue, okay? So the, kind of ran out of room here. The total cost, I'll have to do it a little bit over to the side. The total cost, which is also going to be in red, we'll do it up here. The total cost is the average total cost times the quantity. And since the average total cost is going to be $1.10 and the quantity is 100, we're going to have a total cost of $110. Okay, now if I subtract to get the profit or loss, the profit or loss is always going to be the total revenue minus the total cost. Okay, so if the total revenue is 100 and the total cost is 110, we're going to have a loss of $10. Okay, so that's the amount of our loss. Let's go ahead and graph it up here. Let's highlight this area or illustrate this area all the way up to 110 over to the quantity of 100. That's going to be our total cost. Okay, now you can see that this area here is higher or greater than the area of total revenue. So this is going to be the area of loss, and that loss is going to be a $10 loss. Now, hopefully for this firm, this situation turns around and eventually perhaps the demand will increase for the product. And if that were to occur, an increase in demand would have the effect of raising the price. Okay, and if the price were to go up, then we'd have a situation where this firm might have a profitable company again. Conversely, let's suppose that didn't happen. So the goal would be for the price to be equal to at a minimum, for the price to be equal to the average total cost. But another thing could happen, because so many people might be earning losses like this corn farmer, you might also see a decrease in the supply. And if you see a decrease in the supply, that would also have the effect of raising the price. And let's say the price goes up to $1.10, and that would return this situation to what we would call normal economic profit. So a lot of different things can occur here, and those are just a couple of them. So this is a situation where a firm is earning they're earning an economic loss in the short run. Now the final situation that we could run into and final condition that a perfectly competitive firm may face is what we call shutdown conditions. Shutdown conditions are where the firm is facing a loss, but they might actually save money by shutting down rather than remaining open at a loss. And the rule is for the what we call the shutdown rule is that you shut down when the price is less than your average variable cost, right? So you might think of a situation where if you're selling, say, let's take an ice cream cone, and the ice cream itself that you're selling cost you $1.10, and you're only selling the ice cream cone for, say, $1. You're actually losing a dime on that additional ice cream cone that you're selling. So you actually be better off by not selling it. But let's, in any event, let's just take a look at what it would look like. So in this particular case, you're going to have an average total cost. It's going to look way up here somewhere. Then you're also going to have your average variable cost, because we need to know our average variable costs. And the average variable cost is also going to be up higher. And your marginal cost, of course, is supposed to intersect with your average variable cost and your average total cost. Whoops, I can't talk at the same time as I write, or else I write what I'm saying. So that's your marginal cost here. So in this particular situation, you might normally say, well, where do we produce? Well, in this case, you don't, because you can see that the price or the marginal revenue that we're getting from each additional unit is actually less than whatever it is that my cost is for each unit. So by selling additional units, I'll actually accelerate my losses, which is not a good idea. And so for this graph, we're not going to plot anything. One can think of a number of different businesses that do shut down. For example, an ice cream parlor might shut down in the wintertime for just a couple of months because they deem that the losses that they'll make, that they'll incur by shutting down, are actually less than the losses that they would have if they were to stay open in those months where business is very slow. Theme parks, ski lodges, things like that. There's lots and lots of, especially seasonal businesses, that do shut down when they believe that they're going to actually accelerate losses by remaining open. Now, of course, in the long run, you can't stay closed. So obviously, the only reason that a business would shut down temporarily like this is if they expected conditions to change. So for example, let's just assume that there's a large increase in demand coming. That's going to push the price up, and then perhaps we'll return to long-run equilibrium where they're making, at a minimum, they can operate at a loss, or perhaps they can make an economic profit. So these are the four basic conditions that you're going to see for a perfectly competitive firm.